Good morning, everyone. Welcome to this seminar that we are holding together with the Bank of International Settlements and Bank of Mexico as part of the seminar series that we have together with them. It is our great pleasure to receive today Stephen Haber from Stanford University, where he is the Peter and Helen Bing Senior Fellow at the Hoover Institution, and the A. and Jan Welch Milligan Professor in the School of Humanities and Science at Stanford University. He is also Professor of Political Science, History, and Economics by courtesy. He is a Senior Fellow of both the Stanford Institute for Economic Policy Research and the Stanford Center for International Development, and he directs the Hoover Institution Working Group on Intellectual Property, Innovation, and Prosperity. He is among Stanford's most distinguished teachers, having been awarded every teaching prize Stanford has to offer. He is the only member of the Stanford faculty to have been awarded the Dean's Award for Distinguished Teaching, the Alan B. Cox Medal for Faculty Excellence in Fostering Undergraduate Research, which is Stanford's highest teaching honor. Haber's ability as a teacher and mentor were acknowledged by the Economic History Association, which at its 2013 meeting awarded him the Jonathan R. Hughes Prize for Excellence in Teaching. He has spent his academic life investigating the political institutions and economic policies that delay innovation and improvements in living standards. Much of that work has focused on how regulatory and supervisory agencies are often used by incumbent firms to stifle competition, thereby curtailing economic opportunities and slowing technological progress. He is the author or co-author of 4 books and the editor of 5 more, among them the one that he is going to be presenting today, Trial by Design, that was co-authored with Charles Calomiris from Columbia University. He is currently working in 2 research areas. One of them focuses on the impact of geography on the evolution of society's fundamental economic and political institutions, and the other focuses on the impact of the U.S. patent system on innovation and competition among firms. He received his BA degree from George Washington University and his PhD from UCLA. So without further ado, please let me welcome Stephen Haber. Thank you very much.
Thank you very much for that very kind and generous introduction. I'm delighted to be here at SEMLA. This is my second time, but it has been more than 20 years since I was back at SEMLA. I was here in 1987 giving a seminar. And so it's a delight to come back, and I hope that it won't be another 26 years or so before I return, because by that point, you guys definitely won't want to hear from me. Okay, I thought that was funny, but I should say by way of introduction that I'm a New Yorker, so we tell a lot of jokes, which is how we survive life in New York City. My co-author, Charles Calomiris at Columbia University, is also a New Yorker. And so we spent 4 years writing Fragile by Design and telling each other jokes. I like to think that the book captures both our sense of humor and our passion for financial history, or what I call analytic financial history. The question that we ask, and I should say before we start, that as I'm speaking, people should feel free to ask questions as we go. You should feel free to interrupt, because usually the questions that come up as we go along are more interesting than what it is I have to say, and it creates a more interesting interaction between me and everybody else. So please feel free to interrupt. The question that motivated us to write this book was a puzzle that's that's become very obvious since the subprime crisis, although it's been a puzzle that's been there for a while, which is if stable and efficient banking systems are so good for economic growth, why do we observe them so rarely? There. Here we go. So I won't go through all this literature, but there's a big literature both from cross-country regressions, beginning with King and Levine and Zervos, evidence from cross-regional studies, evidence from economic history, and studies of finance-dependent industries, that causality runs from stable and efficient banking systems to economic development, and not the other way around. This was a big debate going back to the 1930s as to which way causality runs. And in the 90s, it was pretty much settled that causality obviously runs both ways, but there is an independent effect running from financial development to growth. So that poses a question, well, if stable and efficient financial systems are good for growth, how common are stable and efficient financial systems? So the first thing that we did was to take the database of Levin and Valencia from the IMF and combine it with the World Bank Financial Structure Database, and only include those countries where there was data from both databases, and only include countries that are not communist or former communist countries, which are very crisis-prone, and only include countries with more than 250,000 people. And then ask the question of the remaining countries, roughly about 120 countries, how many of them have been crisis-free, that is, not had a systemic banking crisis since 1970? And the shocking answer is only 29%. We were quite stunned when we saw that. About half of the world has had at least one crisis, and about another 20% of the world has had two or more crises since 1970. Now, to give you a hint about what those countries have in common, does anybody want to guess what the most crisis-prone country is? That is, crisis in terms of systemic banking crises so large they can take down the entire financial system. What country has been the most crisis-prone? It's in Latin America. It's Argentina with 4, followed by the Democratic Republic of the Congo with 3. So there's a pattern beginning to emerge between governance and crises. Well, if you take a look then at the crisis-prone countries, I've already mentioned Argentina, the DRC, Chad, the Central African Republic, Cameroon, Kenya, Nigeria, the Philippines, Thailand, Kenya, Turkey, Bolivia, Ecuador, Brazil, Mexico, Colombia, Costa Rica, Chile, Uruguay, Spain, Sweden, and the United States. This is not a random draw of the world. It suggests that the standard explanation, what I like to call the Tim Geithner explanation of financial crises, which is we do the best we can, but sometimes bad things happen that nobody could foresee. That crises are like hailstorms or mountain lion attacks, simply cannot be right. They're not the result of unforeseeable events. If they were, they'd be crises. Systemic banking crises would be randomly distributed, but they're not. It also, of course, begs an interesting question of what the United States is doing in a group of countries that also includes Cameroon, Chad, and the DRC. And I'm going to spend some time on that today. Similarly, if you believe that unforeseen shocks cause banking crises, then you'd have a hard time explaining why it is that Canada has a much more stable banking system than the United States. So this is the frequency of systemic banking crises since 1840 in the United States and Canada. You can't see the Canada number because it's 0, including in the Great Depression. And the United States has had 12. So I like to say when I speak to Canadians, you see, we win again, 12-0. And it can't be the case that the Canadians and the Americans don't know what each other is doing because they don't share a common language. So, in fact, what's interesting about this is that the Canadian banking system is based upon the initial U.S. banking system that existed at the time of the Constitution was signed. This was Alexander Hamilton's banking system. And in fact, the Bank of Montreal, Canada's first bank, basically took the charter of the first Bank of the United States, crossed out Bank of the United States, wrote in Bank of Montreal, and that's the sort of the model of the Canadian banking system. So if you really believe that banking crises are randomly distributed, you'd have a hard time explaining this pattern, especially in light of the fact that Canada, compared to the United States, is a smaller, much more open economy that's a natural resource economy and has far more shocks, natural resource commodity shocks than the U.S. You would expect Canada to have more systemic banking crises than the U.S., but in fact you observe the opposite. For those of you who might worry that, oh, it's because Canada doesn't have a banking system, we actually calculated the amount, the ratio of bank credit to GDP in Canada and the U.S. since 1913, actually since 1910. Canada's in red, U.S. is in blue. You can see that for most of their histories, they tracked each other quite closely, and then bank credit since the 1970s grew much faster in Canada than the U.S. So it cannot be the case that Canada is less crisis prone because it has a tiny banking system. So one of the things that we decided to make clear in Fragile by Design is that in order to have a systemic banking crisis, two things have to happen at the same time. Banking crises are not mountain lion attacks. They're not hailstorms. You have to have two things occur simultaneously. First, you have to have high levels of risk on bank balance sheets. And second, there has to be inadequate capital backing those risks. Now, we didn't discover this. These facts are as old as black thread. Everybody knows them. You learn it in any introductory finance course. And so you have to ask yourself the question then, how is it that bank regulators don't see high levels of risk on balance sheets and low levels of capital? And the answer is, of course they see it. And the interesting question is, why don't they do anything about it? That's a question that we pursued in Fragile by Design. Now, the other part of this, one way to have a crisis-free banking system is to basically have no banking system. To have a banking system so tiny that it can't fail. We were also concerned with scarcity of credit. And so we took the World Bank Financial Structure Database. We took the average from 1990 to 2010. And then we divided the countries up by the World Bank's income classification. So on the left here is the low-income countries, places like the Democratic Republic of the Congo and Chad. Next to them are the lower middle-income countries, places like Cote d'Ivoire, Swaziland, the Philippines. The next group are the upper middle-income countries, where you see Mexico, Brazil, Chile. And finally, on the far right, the high-income countries, where you see the U.S., Canada, United Kingdom, Sweden, and the like. And you notice, of course, that there's a relationship. As you move from poorer countries to richer countries, the size of banking systems or the private credit from the banking system to GDP grows. That's not surprising, but it's a well-known fact. But what you also notice is an interesting fact, which is that within each category of income, there's a lot of variance. So if you look at Mexico, for example, compared to other upper middle income countries, it's quite underbanked. In fact, the ratio of credit in Mexico to GDP, which is here is about 22%, is the same as the ratio on the average for the next lower group of countries. There's countries with an even lower per capita income, also 22%. It suggests that there's also systemic or systematic underbanking in some countries, that relative to their GDP, they're providing very little credit, suggesting that there's some inefficiency. So, yes, sir.
There is this definition in the literature about financial systems that are based on banks and non-bank financial systems. How will the picture change if you define crisis as in a more general sense? Namely, if you would consider crisis in those other non-bank sectors markets.
I don't have an answer to that question because we didn't do that analysis. We didn't because when we started this project, we considered also looking at financial markets. But it quickly became obvious to us that looking at banking systems around the world and over time, as you'll see that we go back 3 centuries, if we added financial markets to it, we would still be writing. We were also struck by the fact that the places that have well-developed securities markets also tend to be places that started, as their securities markets, came out of banking systems. That is, there's this relationship between a banking system and a securities market because the banks play fundamental roles as underwriters of securities. And because the first securities that are often issued on markets were in fact the securities of banks. So I can't tell you with certainty how this would look. My sense is that you would have far more financial crises in developed countries because they have bigger securities markets. And the securities markets of places like the Democratic Republic of the Congo are so small that I wouldn't know what it would mean to have a crisis there. But it's a question that somebody should examine. So we then asked the question, well, exactly how many crisis-free countries, that is, no systemic crises since 1970, countries are there that also have high levels of credit, where we defined a high level of credit as being one standard deviation beyond the mean of the relationship between bank credit to GDP. That's about the level of Australia. It's a ratio of bank credit to GDP of about 80%. As a robustness check, we also set it at the mean, which is about the level of bank credit to GDP in Bolivia. It doesn't change the results very much at all. Okay? So how many crisis-free, abundant credit countries are there? Well, there's 6. When we did this, we couldn't believe it. So we decided to go away, drink a bottle of wine, have dinner, come back the next day, and do it all over again from scratch. And we got the same answer. So it wasn't like we made an error in Excel. They are, and they all have something in common. Singapore, Malta, Hong Kong, China, Australia, Canada, and New Zealand. Now you notice something interesting about all of them. They're all former British colonies. The first 3, well actually one of them isn't even a country. Hong Kong's not a country. It's a city-state. And in fact the first 3 are all relatively small islands with fairly uncomplicated politics. The next 3, Australia, Canada, and New Zealand, in addition to being former British colonies, share some interesting features, especially Canada and New Zealand. They have rather unusual constitutions that we'll talk about later. Particularly in the Canadian and New Zealand case, they set up initially senates that were not elected. They were appointed by Her Majesty the Queen, and the Canadian Senate still is. So Canada is one of the few democracies in the world without an elected Senate. In fact, the Senate serves without limit of term. They're like tenured professors, except they don't have to publish papers. All right, so what's the flip side? How many high crisis, low credit countries are there, and what do they have in common? So we took the countries that are one standard deviation below the mean in credit to GDP and have had more than 2 or more crises. Well, who are they? What's Chad and the Democratic Republic of the Congo? What if we redefine it as you just have to be one standard you just have to be below mean credit to GDP and have 2 or more crises? Well, then you got another interesting group. Argentina, Bolivia, Brazil, Cameroon, the Central African Republic, Colombia, Costa Rica, Ecuador, Kenya, Mexico, Nigeria, the Philippines, Turkey, and Uruguay. Now ask yourself the following question. How many of those countries have been stable democracies since 1970? Only 2, Colombia and Costa Rica. The other 14 were either countries that were autocracies or transitioned from autocracy to democracy. It suggests that there's a pattern. The pattern is that there's a causal relationship between autocratic government and unstable and narrow banking systems. But the data, because of the United States, and also suggests that not all democracies are created equal. There are democracies in which populist currents are able to overwhelm liberal institutions, and I'll talk a bit more about this in a minute. That the populist currents overwhelm the liberal institutions that give rise to coalitions between bankers and populists against everybody else. What I mean by this is that every democracy has 2 tensions within it. The populist vision of democracy is everybody gets one vote, and whatever the majority decides is the will of the people, and the will of the people is sacrosanct simply because it is the will of the people. The liberal conception of democracy, which goes back to the 18th century, is that voting is simply just another form of controlling tyranny. And that one form of tyranny that can exist is the tyranny of the majority. What would be to prevent the majority from voting away all the wealth of a minority, or enslaving them, or discriminating against them in any way possible, right? Lots of kinds of ways. And so in the liberal conception of democracy, there have to be safeguards against tyranny, including the tyranny of the majority. And those safeguards include things like bicameral legislatures, representative institutions, Supreme Courts that serve for, Supreme Courts. In the U.S. case, initially an unelected president, that is an indirectly elected president. That was a sort of a new innovation of the United States. In the U.S. case, originally a Senate that was elected by the state legislatures, not by a popular vote. In other words, firewalls against the tyranny of the majority. Now, every democracy has tensions between these 2 visions of democracy. The notion that the will of the people should be expressed and obeyed, and the idea that institutions are necessary to protect against the tyranny of the majority. And it's no secret that in every country, every democracy, there's a back and forth between populists and 19th century liberals. We're currently seeing that in the United States. That, in fact, is what the 2016 presidential election in the U.S. is going to be about. One of the points we want to make here is that one of the things that can happen, so in an autocracy, it's very clear what can happen, which is the autocrat makes an alliance with a small group of bankers to provide credit to the state, in exchange for which the bankers get protected markets and don't have to compete very hard against one another, to give them the rents. They're given incentives to invest their money in the bank because they know at some point the autocrat is going to expropriate them. This is easy. You see, we're going to talk about a case like this in a minute, which is Mexico under Porfirio Diaz. But under democracies, there's this other problem, which is if you have a strong populist current and it can overwhelm the liberal institutions, the bankers see it coming. What do? What's their best move? Their best move is to form a coalition with the populists and make an alliance against everybody else. And that's the history of the United States. So, in this sense, what we're arguing in this book is that countries are not really choosing their banking system in the sense of the word that we usually use the word choose. We no more choose our banking systems than we choose our shoe size. We get the banking systems that our political institutions and our politics permit. And that means that in order to understand bank regulation and therefore the structure and performance of banking systems, one has to understand the politics of the country and its political institutions. All right. How did we go about identifying these relationships? Well, so we went to JPAL and we conducted a randomized field experiment in which we traveled back in time 300 years and randomly assigned countries to autocratic and democratic political institutions, and then we waited to see what happened. But when okay, that was a joke. Some of you are smiling, you get the joke. These randomized field experiments are all the rage in development economics, but also now in political science. So I think it's funny okay, but you get the joke, and trust me, this has become a sort of a cult among social scientists. But obviously we couldn't do that. So we had to do the next best thing, which is that we went back and we read histories and we did archival research. Now, this archival research doesn't represent just the 4 years that Charlie Calamiris and I spent writing this book together. It represents 25 years of work that each of us has done before we even got together. We've known each other a very long time. So those of you who know me know that I've been writing papers about the Mexican financial system since 1991, back when Madonna was still alive. Okay. So, but we didn't do historical research without a theory. I mean, one of the problems of historical research is that people wander around in the dark collecting information on everything they can find. And of course, then they can't find a pattern because everything, you can't study everything, right? You have to have a guide. And so we started with the basics of finance. And so there's 3 basic property rights problems that have to be solved in order for there to be a banking system. And they're not easy to all solve at the same time. And I'll show you why in a minute. The first is that the majority shareholders, the minority shareholders, and the depositors have to be protected from expropriation from the government. And the government has lots of ways to do it. There's, of course, de jure expropriation, but there's all kinds of de facto expropriations, like raise the deposit reserve requirement to 70%, and then don't pay interest on the deposit reserves, and then run an inflation. Easy enough. The second, or the government decrees that banks should make loans to particular kinds of firms, and then it tells those firms, you don't have to repay those loans because you're strategic sectors, and it forces the banks to roll over the loans. It's another form of expropriation. Okay, the second problem is that depositors and minority shareholders have to be protected from expropriation by the majority shareholders. That is, the minority shareholders and the depositors have to be protected against tunneling and fraud. And the third is that the majority shareholders, the depositors, and the minority shareholders have to be protected from expropriation by debtors, which is to say that debtors take out a loan and don't repay it. Now, each of these property rights problems are linked by the fact that they involve the government. That is, the last 2, tunneling and fraud, and the need to enforce contracts, requires the police power of the state. But the government has all these conflicts of interest. First, the government simultaneously borrows from banks and regulates them. Second, the government enforces debt contracts, but it needs the political support of debtors. People don't vote for the guy that just threw you out of your house and padlocked the door. The third is that governments distribute losses in the event of bank failure, but they need the political support of depositors. Nobody votes for the guy who just told you that the bank lost your life savings and there's nothing the government is going to do about it. These inherent conflicts of interest are endemic to all banking systems. They're inevitable. And all governments, therefore, find themselves in the position of being conflicted between the survival of the government and the stability and performance of the banking system. This is an example of the kind of slide that somebody should never ever put up because it has far too many words on it. But it comes down to this, that there's no such thing, when you stand back and look at it, the idea that there's a government and a banking system and they're independent of each other is a certain fiction. Really, there are partnerships between governments and banking systems, or between governments and bankers. And those partnerships between governments and bankers over the regulatory system that will govern the banking system vary across democracies and autocracies. These partnerships can be extremely complicated. They're not transparent. They often involve unlikely partners, and it's often very difficult for the public to see what's going on, and that's the whole point. Under autocracies, these partnerships, what Charlie and I call the game of bank bargains, is often quite simple. Government restricts bank entry. That provides bankers with rents. They lend some of those funds then to the government to support the continuation of the government. They know that at some point they'll be expropriated, but they're being compensated for expropriation risk by high returns. Minority shareholders buy stock in these banks because they too are earning high rents, because they know that there's a chance that they're going to be expropriated by the majority shareholders through tunneling and fraud, and the government will look the other way. But the whole thing is sort of held together by rents, which is to say, by limits on competition. Under democracies, the bargain is often about trading political support to debtors for privileged access to credit. That is, governments want the support of voters who will vote for more credit. We'll see this in the history of the United States in a minute. But that creates a danger that the bankers can be expropriated by the debtors. And so that means that the bankers and the debtors have to find a way. Either of two things have to happen. Either the bankers have to form a coalition with the government to prevent the debtors from expropriating the bankers, or the government, or the debtors and the bankers have to form a coalition against everybody else. That's the story of the United States, the latter story. Okay. All right, so now what we did was we picked countries that had great beaches to study. All right, another joke. Basically, what we did was we wanted to look at countries that had variance across countries in their political institutions, but also variance within the country over time in their political institutions. So we focused on Great Britain, Canada, the United States, Mexico, and Brazil. Now, you may ask, why didn't you pick some other country? And the answer was because this already took us 4 years. There's a 14th chapter of the book where we talk about other cases. We go through China, Chile, Germany, and some other European cases, a little bit on Spain, but we didn't have the time to do the kind of exhaustive, long-run historical study where we learned the political institutions and the politics, and then learned the history of bank regulation, and then learned about the structure and performance of the banking system. This is not an enterprise characterized by returns to scale. And so we focused intensively on these 5 countries, but then to make sure that what we did was robust, we did other case studies, particularly looking at outlying cases, but also looked at the available cross-country regression evidence, which there are several studies, and we found that the results are basically robust. That said, we want to be clear that we're not claiming to have the last word on this topic. Whether we are right or wrong can only be determined by other researchers who look in depth, as we did, at other cases. We may turn out to be wrong, we'd be happy to be, if what it produces is analytic economic histories of the politics and banking systems of the rest of the countries in the world. Sir, question.
In one of the other books, your other books, The Politics of Property Rights, you develop a concept, BPI, Vertical Political Integration Arrangements. How that concept relates to the game of bank bargains that you're, is that a particular case? Can you elaborate a little bit?
Yeah, thank you for having read that book. I like to joke that I know my mother read it. So in vertical political integration, we basically, so the Politics of Property Rights, which was published in 2003 with Armando Razo and Noel Maurer, was a stepping stone on the way to fragile by design. We were interested in a particular kind of autocracy, in which what we come to call in fragile by design a centralizing autocracy, an autocracy that's not yet so powerful that it can overwhelm everybody else, and so it needs to find partners. It's a particular form of the game of bank bargains. In fact, I'm going to talk about that kind of centralizing autocracy that has to form an alliance with other groups in order to create a stable coalition. In a minute, we'll talk about the case of Mexico under Porfirio Diaz. But you're exactly right. Vertical political integration was a stepping stone on the way to a larger theory. And in fact, it sort of goes to the point about where do theories come from, because the truth of the matter is that we like to pretend that we invent theories in some abstract way sitting in our cubiculos. Theories actually come from studying cases. And there's an interaction between empirical research and theory, which is one of the reasons why any theory that Charlie and I developed in this book, in some sense, can only be tested by other people, because our theory couldn't help but be informed by our empirics. Okay, so let me take then a few minutes, because I want to leave plenty of time for discussion, into what the game of bank bargains look like in a VPI kind of setting. One of my favorite cases, in fact, the case that started me as a scholar, I wrote my dissertation on Porfirio in Mexico, and my first paper on financial history was on Porfirio in Mexico. So this is Mexico under the dictatorship of Porfirio Diaz from 1877 to 1911. So here's, in a nutshell, the problem Mexico had in the 19th century. We today think of Mexico as a country with stable borders, with a central government, and with regular elections and institutions. I realize that those have been under pressure, but we don't doubt the viability of the Mexican nation state. If you were to look at Mexico in the mid-19th century, you wouldn't have drawn that conclusion. Half of Mexico got stolen by the United States. Central America originally was part of Mexico. It secedes within a few years of independence. The Yucatan secedes in the 1840s, forms its own country, only comes back in later on under its own volition after it's rejected by the United States to join the U.S. Of course, Texas secedes. There's more presidents than there are years in Mexican history from 1821 to 1875. I mean, Mexico is basically, in the 19th century, a country characterized by warlordism. So, a dictator, military figure, in fact, who defeated the French at the Battle of Puebla, Porfirio Diaz, comes to power in 1877, and he's the first to create a stable government. And he realizes that what he has to do in order to survive politically, to create a stable banking system because Mexico doesn't have one. In fact, it only has one chartered bank in the entire country, which is the Banco de Londres y México, which was a branch of the London Bank of Mexico and South America, which only existed because it got a charter from the French during the 5 years that the French had invaded Mexico and ran Mexico as a puppet state. So he's got to create a banking system. And why? Well, because he's got to finance the state. Why does he have to finance the state? Well, it's because he's got to build railroads in order to connect the country. Why does he have to do that? Because he's got to end the power of the warlords. He's got to be able to move soldiers around the country, and he's got to create a unified market. But all railroads everywhere in the world, including to today, are built with subsidies. And those subsidies come from the government. They come in various forms. And Diaz has no form of subsidy. So he has to create a banking system in order to create subsidies, in order to build a railroad, in order to create a country that can be stable, that can stand up to the gringos. That's his basic problem. And that can unite the country. So what does he do? He takes a card out of of the Bank of England, in which the British government in the 17th century said, oh, we have to fight the French. How on earth are we going to do that? France is such a big country with such a big population, and Louis XIV is such a bad guy. And they create the Bank of England, which basically exists for its first 135 years to finance wars against France, in which the government trades special privileges. That is, basically the Bank of England has a monopoly, various kinds of monopolies. I don't have time to go into it. In exchange for which the Bank of England is always giving bonuses to the government in order to prosecute the war against France. And so, in fact, the Bank of England, in the English case, doesn't become the Bank of England that we all know today until the end of the Napoleonic Wars. Well, then it can start to be, a real bank. So what Diaz does is he takes a page out of the Bank of England book and he creates a bank that you all know today, Banamex. In fact, its competitor, the Banco de Londres y México, later on gets renamed Banca Serfín, which still exists today. Okay, so what does he basically do? Because I don't have a lot of time to go into this. He creates a coalition with these bankers, with the guys who sit on the board of Banamex. They get the right to issue notes up to 3 times the value of capital. They get the right to run the mint. They get the right to collect the customs duties. They get the right to open branches anywhere they want in the country. They become the government's sole creditor. And so they're earning very big rents. Right? He's offering them very big rents in exchange for becoming the government's banker. In exchange for which they lend 40% of the bank's assets to the government. This is, how do they make this stable? This is sort of this VPI idea. Well, what's to keep the government from at some point expropriating the bankers? Well, the bankers go out and recruit members of the government to serve on the board, including the Undersecretary of the Treasury, the President's son, and others, the President of Congress, all of whom are receiving director's fees. And so they create a coalition in which if the government expropriates the bankers, it's also harming members of the government itself. Very simple game. Now, remember, Mexico's got a federal system at this time, and the state governors are extremely powerful, much more powerful than they are today. In fact, they control militias bigger than the federal army. So they demand the right to do the exact same thing Diaz does. And there's a long fight in this that takes place both in the Mexican Supreme Court and it takes place in the halls of the Secretary of the Treasury. But basically, the deal that they hit on in 1897 is that state governors are going to be able to pick one group in each state that will get a limited territorial concession for that state. And that bank will get all kinds of special privileges in order to raise its rate of return high enough to protect it from the fact that at some point they know they're going to get expropriated. That means that in any state, you never have more than 3 banks. Rarely. There's a few cases where you do. You have the state bank with the state charter. It's not a state-run bank. It's an individual group tied to the state governor, who often sits on the bank board and gets loans from the bank board that he then doesn't repay. You have a bank, you have a branch of the Banco de Londres y Mexico sometimes, and you have a branch of Banamex. Okay. This system, should go back. This system allows the banking system to grow. So the blue is the number of banks, and you'll see that it basically comes out at about the number of states, plus Banamex and Banco de Londres y Mexico. And you'll see how it grows from almost nothing in 1897 to about 35 banks at its peak. Red are bank assets as a percent of GDP, and you can see that they hit about 35%. That's about the ratio today in Mexico. This is, by the standards of Mexican history, quite a big banking system. Okay. Now I'm going to skip the next slide for the sake of time. Bank shareholders earn rent. This is from work I did with my former student and colleague, co-author, and close friend, Noel Maurer. This is the ratio of market values to book values of bank stocks in Mexico. And you can see that it's over 2 by the end of the Porfiriato. That is, a lot of the value of these banks is in the charter. It's in the fact that they've got special privileges. This is a non-competitive, wait, I'm going the wrong way. Who did bankers lend to? They lent to themselves. Why'd they do that? Well, if you're not competing very hard, who else are you going to lend to? The bank, I mean, Mexico's bankers are all like bankers that existed everywhere at this time, which is you formed a bank because you wanted to finance all the downstream enterprises of all of your other downstream enterprises, your manufacturing firms, your commercial firms, etc. So we did an analysis of lending by Banamex. This is lending that doesn't have a federal guarantee or that's not to the federal government. How much of the lending between 1886 and 1901 went to enterprises owned by the bankers themselves? And the answer is 100%. For other banks, the ratios run between 29% to 86%. One of our favorite cases is there was a discussion later on in Banamex about lending to the Banco Oriental de Puebla. And the board of directors objected, saying, well, we don't lend to people who aren't us. And Antonio Basagoiti, who is one of the directors of Banamex at the time and one of Mexico's most sort of famous financiers, explained, oh, no, it's okay. Because the Banco Oriental de Puebla only lends to its own directors, and they're all good guys. So it's a safe loan. What makes this banking system stable? You have very high capital ratios. Okay? So the ratio of capital ignore the slide. Let's go back. The ratio of capital to bank assets is about 25%. These are very highly capitalized banks in which big tranches of the stock are owned by the majority shareholders. And there's lots of cross-investment of one group of bankers into another bank. The law required independent directors. And so there are almost always other bankers. And so what appears to be the case is everybody watched everybody else like a hawk, with a lot of capital at risk. And so when Mexico got hit by the crisis of 1907, which was a contagion from the U.S., one of the interesting features is Mexico ran a bailout, which was financed by the largest banks, and it's maybe the only bailout in world history that actually made money for the shareholders. Because the bailout bank only bought good, that is, high quality debt from the banks to inject liquidity into them. So this system is stable, it's growing, but it's providing credit very narrowly. If you're the average Mexican farmer, you have zero probability of getting any bank credit. If you're a small manufacturer, you're not getting bank credit. Bank credit is going overwhelmingly to large firms. In fact, another work I've done, I've shown that if you have that the biggest textile manufacturing firms in Mexico are all connected to the banks. And then Mexico has this really weird structure. So textile manufacturing is usually characterized by near perfect competition, except in Mexico, where 4 firms controlled about 40% of the market. And those 4 firms are all tied to the very biggest banks in Mexico. Okay, but I don't want to spend too much time in this. And I'm going the wrong way because people over the age of 30 should not be allowed to drive PowerPoint. Okay, this system relied on this VPI, vertical political integration, or what Charlie and I call the centralizing autocracy. When that autocracy went away in the Mexican Revolution, the banking system went with it. And what's really interesting is that everybody preyed on the banking system, regardless of their stated ideology. If you were pro-business, if you were anti-business, it didn't matter. Why? Because if you didn't do it, the opposition would. And then they'd kill you. And so every side preys in the banking system. The currencies are, in fact, in some sense, the worst. And they basically kill this banking system. So that by the time you get to the early 1920s, the ratio of bank assets to GDP is at about 5%, which is to say it's sort of the banking system today of Burundi. Fundamental problem, and I don't have a lot of time to go into this, but a fundamental problem that then the PRI faces as it comes into existence is it has a lot of trouble getting the bankers to trust it. So they don't. And the ratio of bank assets, commercial bank assets to GDP remains small. In fact, this is credit from commercial banks to GDP in green, and you see it never exceeds about 6%. This is from 1925 to 1979. That's a really low ratio. The biggest banks also own financieras, basically investment companies. At its peak, that hits about 11%, so you can get a ratio of private credit to GDP of about 17%. And then that gets killed off by the inflation tax of the 1970s that Echeverria and Lopez Portillo put into place. And so that what you have to have then is a development banking sector, of which Nacional Financiera is the largest. Now, I don't have a lot of time to go into this, but what's really interesting about this is this looks like a stable banking system, except what's really going on here is that what commercial banks and financieras are the treasury wings of large industrial and commercial conglomerates. The biggest of these is the Legarreta Group. And they basically use the financiera and the bank to finance the commercial and manufacturing enterprises of the group. The development banks, particularly the Nacional Financiera, are serving as second-tier lenders to the commercial banks, but they're also taking shares or making loans directly to those same industrial and commercial groups. And so studies that have been done of the lending portfolio, for example, of Nacional Financiera in the 1960s shows that 17 firms get all the credit. And then when the PYMEs complained about this, they said, yes, we'll do something about it. And they allowed them 4% of the banks of Nacional Financiera's assets. Is to say that what you basically have here is a system in which the losses from the commercial banks and the financieras can be transferred to the development banks, which is why you see the size of the development banks skyrocketing at the same time that you see the credit from financieras collapsing. This is how it is that Mexico goes from having 85 state-owned enterprises circa 1970 to almost 1,200 state-owned enterprises by 1982. Basically, Nafinsa is buying up failed firms. Okay. Yes. So, I think of it this way, that the fundamental problem that the Mexican government has after the revolution is that it needs a banking system, but the bankers don't trust it. In fact, in The Politics of Property Rights, another book that I suggest you give everybody as a Christmas present, we show that there are various attempts to get a banking system going again, except that the government keeps cheating the bankers. And so what they basically do in 1924 is they create Banxico as a kind of commitment device, which at the time is not a central bank. And you're able to coax some bank capital back in, right? The problem is that as the PRI takes form and it starts to turn Banxico into a central bank and put Banxico in charge of regulating the private banking system, and as the PRI is consolidating power, and as it's expropriating other sectors of the economy, the bankers start to get very nervous. And so there's not a lot of investment in commercial banking because of the threat of expropriation. For that reason, the government is forced to create the development banks, which act as second-tier lenders. Essentially what they're doing is they're saying, we will subsidize the parts of the economy that the banking sector isn't lending to. And later on, what they're basically doing is buying up bad loans from the commercial banks, which creates this moral hazard problem. Remember when I said that one of the sort of fundamental problems of creating a banking system is you have to convince the bankers the government won't expropriate them, or you have to give them incentives to invest even if they are going to be expropriated. You have to create rents for them. And the PRI does not do that. It fails to do that. And so the banking system of the commercial banking system of Mexico stays extremely small. It's really quite shocking how little credit there is in Mexico in this period. 4 of the banks, incidentally, control 70% of the credit, and they're all tied to big industrial groups. So the average Mexican is pretty much locked out of credit markets. Let me see if I can advance this. All right, I don't have a lot of time to go into this. There's another, you all know well the story of what happened when Mexico nationalizes its banks in 1982, and then privatizes those banks, and when it privatizes the banks, it does it with leveraged buyouts, and it creates a disaster. Charlie and I talk about this in Fragile by Design. Some of that work comes from a shorter work that was just released yesterday by the Centro de Estudios Espinos Iglesias called Esos son los tiempos buenos, where we go into this in considerable detail. So I won't spend a lot of time in this other than to say the following, that when President Salinas de Gortari decided to reprivatize the banking system in 1991, he faced a fundamental problem, which is how do you convince bankers that they should invest in banks that the government can expropriate all over again? And how do you do that and get a high price for the banks? And the answer that they come up with is, we'll privatize the banks by letting the bankers borrow the money to buy the banks from the banks, with the collateral being shares in the banks. Now, once you've done that, you removed one of the important social functions of bank capital, which is that in the event of a crisis, there's a capital buffer that can absorb the losses. It also removes a second essential function of bank capital, which is that the people who hold the capital are going to monitor the bank directors or the managers. Well, why are you going to monitor them when you actually don't have much at stake? For that very reason. It's not like Mexico's big depositors, big companies, didn't understand what was happening. This made them nervous. So the Banco de Mexico, as of 1992, created unlimited deposit insurance, including for all kinds of credits except for subordinated debt. This removed another essential bulwark of good banking, which is that creditors are monitoring the banks. Well, that's now removed because there's unlimited deposit insurance, which meant that the only group that was watching the banks were the regulators. Now think about the following problem. If in the United States the regulators, a well-developed country, with really good institutions, if in that country the regulators can be forced to look the other way, to give us the subprime, the S&L crisis and the subprime crisis. Imagine how easy that was to do in Mexico, especially with a regulatory system that was really underdeveloped because at the time they didn't even have the information technologies to monitor the banks, because for the previous 9 years the government had run the banks, so what was there to monitor? The result is well known, and the solution, which has gone into considerable detail in the study with Musacchio, which Charlie and I cite and discuss very briefly, but the details of it are in the work with Musacchio, is to let foreign banks in. The government has to find new partners, right, in order to be credible, and it finds partners who are going to capitalize the banks, not with fictitious capital, and who aren't going to own downstream firms that they can use to tunnel into the banks in order to save those downstream firms, which is what occurs in 95 to 98. They go to foreigners. Okay, very quickly, because I've taken more time than I want here, democracy is not a solution in and of itself. Because as explained, you have the problem, debtors can vote basically for more credit and then debt relief. A smart banker sees that coming, and so what does he do? Well, he forms a coalition with the populists. The classic example of this is the 19th century United States. This U.S. is a farming economy. Farmers need credit. The initial banking system of the United States is composed of very large banks. This is Hamilton's vision. Believe it or not, virtually every state government in the United States in the early 1800s was a shareholder in a monopoly bank in its state. That is, the state government gave a charter to a bank. The government typically owned about 30% of the stock of the bank, which it didn't pay for. It borrowed the money from the bank to buy the stock. It then repaid the loan out of the dividend flow from the bank. In some states, a third of state income is coming from bank shares. This beats taxing people. Right? So politicians love games like this because it means you don't have to tax. Now, it created a problem, which is if you're a small farmer, you don't have any credit. Right? This looks kind of like the Mexican banking system of Porfirio Diaz. Except the United States is a democracy with an expanding electorate, with electoral rules that are changing very rapidly. I don't have time to go into explaining why, but what basically happens by the 1810s is that state governments get voted out that have these sort of crony arrangements, and governments are voted in that expand the number of banks so that farmers and artisans can get access to credit. And you get the mushrooming, state by state, of bank charters. However, there's two interesting features of this banking system. The first is they don't allow banking across state lines. You don't allow foreign banks in, by which they meant a bank from Massachusetts. Bankers in Massachusetts didn't want bankers from Rhode Island opening branches. The second is there's so strong anti-monopoly currents in the United States amongst farmers. So you had an alliance of populists and bankers. Small bankers made alliances with farmers to have monopoly banks city by city or town by town. So large cities might have as many as 4 banks. Still a pretty thinly banked market. A small town might only have 1 bank. What's the deal that's going on here? Well, the banker is getting a local monopoly because it's all soft information. You can't lend at a distance. The largest farmers in the town are getting guaranteed access to credit because the banker lends to them or lends to nobody. This coalition of bankers and agrarian populists eliminates the Bank of the United States. That's why we have the first bank in the United States. It gets voted out of existence. Its charter's allowed to fade. We then get a second bank when we realize in order to fight wars against the British, you need a bank. And then Andrew Jackson vetoes that charter. So we get rid of our central bank. It creates this crazy banking system with no branches. Every bank is a single office unit bank. This is the structure of the United States banking system in 1920. The blue is the number of banks. It's a little over 25,000. The red is the number of branches. It's about 500. That's not 500 per bank. That's 500 branches. It is to say that the vast majority of banks don't own branches at all because it's illegal. And the states that do permit it strictly limit it. How long do you think this goes on for? All the way to the 1980s. So think about the following. And I don't know if you guys lived in the United States in the 1960s or 1970s. If you went to a bank and you opened up a savings account, they gave you a clock radio, a knife, a steak knife, or a stuffed animal. Why did they do that? Because the law limited competition across banks. Interest rates were capped. Banks couldn't open branches into each other's territories because there were state restrictions on it. In fact, in circa 1970, only 12 states permitted branch banking at all, and even those states restricted it. What happens? Well, two things kill that system. So the red line is the number of banks, and the blue line is the ratio of branches to banks. And you'll see that in 1986, the two lines finally cross. And you can see that circa today, the average bank has about 13 branches. And that we went from a system of 27,000 banks to a system today of about 5,000 banks. What kills this? The first is the system that we created, and I don't have a lot of time to explain this, the system that we created could only exist without inflation. When you cap deposit interest rates, and you limit competition, and you discourage people from moving from one bank to the other with deposit insurance, and you make it illegal, therefore, for banks to pay interest on checking accounts, and you cap interest accounts, this can only work if inflation's really low. And when we decided to prosecute simultaneously the war in Vietnam and the war on poverty, and inflation took off, there was massive disintermediation from the banking system. Everybody pulled out, which is why you got a stuffed animal. At the same time, there's big technological changes, especially the computer, that allows bankers to lend at a distance, and it allows bankers to get around the branching laws by opening cajeros automáticos. Interestingly, these little bankers, these populist bankers that have local monopolies, they go to court to block the invention of the ATM or its dissemination. It takes 10 years, in fact, for the Supreme Court to finally rule that a bank, an ATM, is not a branch. So this kills, the combination of technology and inflation kills this system. Which gets us to the question of, so if we finally get reforms, both at the state level and at the national level, I don't have time to go into details, but we get rid of all these restrictions on branching. And we allow for finally the Bank of America to be the Bank of America. It used to be the Bank of America was actually called the Bank of Italy. It was a California bank. In any case, it finally is allowed to branch wherever it wants. And the question is, I should mention that system that I showed you before with the thousands of banks, the thousands of unit banks, of course this thing's unstable, right? Because you can't spread risk across regions. And if they're prone to runs. You can't share the deposit base across banks. And so about every 10 years in the 19th century, we have a big financial crisis. Okay. All right. So why is it that we created in the 1990s, we changed all the laws, we allow much bigger banks, and now we all of a sudden don't have a stable banking system? How is it that 20 years later, we get the subprime crisis? This should have made us more stable, the creation of a system of big banks. Okay, so politics now enters again. But the populace this time are not farmers. They're urban. They're urban activist groups like Acorn and other such groups. ACORN stands for the Association of Community Organizations for Reform Now. What do? They quickly learn that you can block a bank merger application at the Fed by showing up at a Fed hearing and testifying that the merging banks are not good citizens of the communities they serve. Good citizenship comes to be identified as being in compliance with the Community Reinvestment Act of 1977, which was a moribund piece of legislation. Back in the days when banks didn't compete very hard against each other, in the unit banking days, there was legislation saying you had to lend in communities in which you had branches. It forced them to lend to urban, low-income urban areas. The banks actually don't do very much of it. They ignore the law. But once you get this merger movement, the community groups figure out, we can show up and we can block a merger. Bankers are not stupid. In fact, I learned this from the president of the Richmond Fed. He said, actually, in the 1970s, we were teaching community groups how to do this. The community groups actually wrote a book. Their umbrella organization actually wrote a book about how to block a bank merger. It's an 101-page pamphlet. You can find it on the web. It's called the CRA Manual. It's a fascinating read. In any case, the bankers figure out that, okay, this is the cost of doing business. We have to spread some money around through the community groups. Well, we'll do that. So then so they start to sign agreements between the merging banks and the community activist groups. These are unlikely partners. These community groups are basically, how would I put it? Well, they're strong populists. They want redistribution. The banks want a merger. So this is at the merger of the Bank of America and Nations Bank, which makes the Bank of America finally the largest bank in the United States. This is in 1994. This is a testimony from George Butts, who's the president of ACORN Housing. We support the Nations Bank acquisition of Bank of America because they will make credit work for low and moderate income people, and they will work with the community institutions. Okay. How many such agreements are there? There's over 170. How much credit is committed by the banks? This is just the agreements between the banks and the community groups. This is data published by the community groups. They wanted to show what a good job they were doing in getting money, commitments from banks. The answer is between 1977 and 2007, $867 billion cumulatively. Most of it in the 1990s, as you can see, during the period of the great merger movement in the banks. What they are basically getting is the right to decide which of their constituents are going to get a subsidized loan from a bank with minimal credit reporting, minimal demonstration of income, and a low down payment. In fact, they brag about it. The banks go along with this because they say it's the cost of doing business. Now let me be clear, this is a lower bound estimate because there are also voluntary agreements that banks enter into that are also recorded by the community groups. And some of that money we know is flowing through the community groups through a similar mechanism. That number is $4.6 trillion. Okay. This is big money. Now, the bankers don't want to hold those loans for obvious reasons. They're not in the business of making high-risk loans to people with weak income streams. So what happens? Well, right from the beginning, ACORN goes to Congress, and it says the parastate enterprises, Fannie Mae and Freddie Mac, that have private shareholders, but that have special federal charters that give them tremendous advantages over everybody else, need to buy these loans. And so I'll read this to you because I think it's remarkable. This is from, again, the president of ACORN Housing. It's ACORN's observation that the underwriting criteria employed by Fannie Mae and Freddie Mac have been developed not for the general mortgage market, which includes low and moderate income homeowners, but the middle income and substantially suburban mortgage market. As a result, it is our firm belief that the underwriting standards dictated by the secondary mortgage market are, now listen to this, at a minimum, income discretionary, and may, by extension, be racially discriminatory. Well, of course they're income discretionary. On what basis would a bank discriminate other than income? Believe it or not, this works. And it results in a thing called the GSE Act, signed by the first President Bush, that requires Fannie Mae and Freddie Mac to buy tranches of loans that fit particular criteria of low income, very low income, or special purpose. Fannie Mae and Freddie Mac, in exchange, get the right to operate with 40% less capital than the commercial banks. They're then able to to create MBS, which they can then sell back to the banks, and the banks can now buy those holding an even lower level of capital. So now you've created a perfect storm, right? You've allowed a bank to issue a mortgage to a high-risk mortgage, sell it to Fannie and Freddie, and buy it back by holding essentially $2 for every $100 in mortgage risk, okay? We've now created the perfect storm of high levels of risk and low levels of prudential capital. Okay. Every few years, the amount of percentage of mortgages issued by Fannie and Freddie that have to meet these criteria for low income lending is pushed up. First by the Clinton administration, but I want to be very clear here, also by the second Bush administration. That's the power of a political coalition. It doesn't matter which party's in power. And so you get to the point where low and moderate income lending, those loans have to be more than 50% of all loans bought by Fannie and Freddie. Underserved areas, about 30%, and special affordable, about 15%. These are overlapping categories, but what they're implying is something over 2/3 of all Fannie and Freddie loan purchases are being politically determined. Now, this is really important. We are not claiming that the CRA caused the subprime crisis, and we're not claiming that the populists caused the subprime crisis. There's people who claim that that's not exactly what happened. Rather, Fannie Mae and Freddie Mac, once they loosened their rules, because in order to accomplish this, they had to keep knocking down their underwriting standards. To the point by 2004, they had agreed to buy no documentation loans without limit. A no documentation loan is exactly that. You write down a number, you claim it's your income on a piece of paper, you sign it, and the bank accepts it without checking anything. In fact, they were making loans that were 125% loan-to-value ratios. Right? Things go completely nuts. And they have to, because you've got to keep knocking down the underwriting standards. We actually have in Fragile by Design, and I encourage you to buy the book and give it as a Christmas present, we actually have the internal emails from Freddie Mac of what the risk managers are saying about all this and what their bosses are telling them. And what the bosses are basically saying is, yeah, we know it's risky, but we have to show that we're in favor of the political mandate of affordable housing. So they fire the risk managers. One of them is now teaching middle school. Okay. That means that what happens is that low down payment mortgages take off. This is the percentage of mortgages with 3% or lower, less down payments. You can see 0% in 1980, and it hits 40% by 2007. And the percentage of risky lending, which is both Alt-A loans, known as alternate to agency, used to be you couldn't sell these to Fannie Mae or Freddie Mac. Fannie Mae and Freddie Mac started buying them in the early 2000s. The combination of Alt-A and subprime loans, these are flows. This is annual flows. So subprime plus Alt-A originations in as a percentage of all loans is only about 5% in 2001. By 2006, it's 34%. Okay, we all know what happens which is that the United States has one really nasty subprime crisis when this bubble bursts. And to give you a sense of the contrast, the green line at the bottom, that's Canada. Now, I don't have time because I spent too much time talking about my favorite country in the world, Mexico, to tell you about Canada. But let me just take 1 minute and then apologize for talking longer than I intended. And I hope it was interesting. Why did Canada avoid this? Well, because it centralized bank chartering from the very beginning. And when it did that, one of the other features of the Canadian banking system is an unelected parliament, an unelected upper house, which turned back historically lots of populist demands on the Canadian banking system. And Canada has a system in which they now revise the bank laws every 5 years. They used to do it every 10 years and recharter all the banks. They then switched every 5 years. So this is a very tightly regulated system composed historically of a few very, very large banks, but in which the banks are not able to operate like a cartel the way they did under Porfirio Diaz, because voters can put pressure on the banks to not have overly restrictive lending requirements. And so Canadians are one of the few countries in the world to have created a system that on the one hand provides abundant credit and then on the other hand does not produce systemic banking crises. Thank you. And again, my apologies for talking too long.
I think now we can open to questions both with you and with people connected over the internet. So.
Sir.
Hi. It's a very bad feeling I have right now about the Mexican system. Do you see a way out of this? Because now you see, once you break a coalition, like the Porfirio Diaz coalition, you get into the Salinas type of coalition, you're still in the same bad equilibrium, let's call it that way. And now then you gave the American example, and once you break one coalition and get into a different coalition, you still get into the bad equilibrium. And since we cannot change our Senate the way the Canadians have it right now, you see a different way to support our financial system right now.
So I think this was the genius of Zedillo, which is that he realized that the old system in which banks basically operated as the treasury wings of conglomerates, which gave them incentives to tunnel into their own banks to save downstream enterprises, was created an inherent fragility. He also had the political problem, which is that people had lost faith both in the PRI as a party and in the bankers. And so he has to find new partners. Partners who aren't going to own downstream firms, so they're not going to tunnel. Partners that are going to have real, not fictitious capital. And partners that are going to be subject to the regulation of their own governments. Also partners that are not going to find it easy to find domestic political allies. It's not like the Mexican public cares about Citibank very much. And so he opens up the market to foreign banks. That stabilizes the Mexican banking system. And Musacchio and I talk about this in our CEY study. But it does not solve the problem of access to credit. Mexico is still a low credit country. There is some weak evidence we detect in our study, but it's weak. It's not statistically significant at 5%. That foreign banks that are bought by foreign banks after the transition lend less than they did before, controlling for everything else, than they did before they got bought, and lend less in cross-section than domestically owned banks. It's weak evidence, okay? Basically what you have is a stable banking system that in fact gets through the subprime crisis without a whole lot of support. The trick now for Mexico is to find a way to increase competition so that bankers only look for borrowers when they have to. If you don't have to compete very hard, then you don't look for new borrowers. And so one of the things that has to happen, but it's a very difficult balancing act for the regulators, is to create new charters to, say, regional banks, or to banks aimed more at commercial credit, which is a big problem for small and medium enterprises, and at the same time hold them to the same capital and other regulatory standards as the big foreign banks. That's going to be, I'm not saying that's an easy thing to do, but I am saying that the nature of democracy is that voters demand credit. And the other thing I'm saying is that for Mexico as a country, one of the dangers posed by democracy is to try to solve the problem of access to credit by making a deal with bankers in which you tell them you can hold lower levels of credit and transfer weak loans backed by low levels of credit to a development bank. That will produce a U.S.-style subprime crisis. And so one of the reasons we wrote Fragile by Design was not to make people depressed. We're depressed enough already. We're both from New York. It comes with being a New Yorker. We wrote it for two reasons. The first was to say to an intelligent public, look, this is how things work. You need to understand the game that's being played, even though you don't understand. There's a game that's being played, and you need to know that it's being played. Right? You're sitting at the poker table, and you're the sucker. Right? The second thing we wanted to point to is that within democracies, there's this inherent tension between demands for increased credit by voters and the requirements of bank stability, the fundamental principle of which is capital and low levels of deposit insurance. Right? Because you've got to create incentives for the stakeholders to monitor the managers. You can't rely on the regulators themselves. That means that for Mexico to expand credit, the regulators are going to have to proceed very carefully, but they're going to have to do it because the public is demanding more access to credit. It will become a political issue in Mexico, as it does in almost every democracy. So I don't want you to be depressed. I want you to be hopeful, but the point I want to make is that it takes a long time to do this. The Canadians didn't.
Thank you. I wanted to ask you, what is your take on this all macroprudential, say, new approach? Because I see. Because most of the political institutions, all the structure that you described before the crisis are still in place. I mean, yes. You have recapitalized banks, and macroprudential policy doesn't seem to point to any of the problems that you are characterizing, at least for the U.S.
Correct.
And for a policy that is also meant to address issues globally, not only in the U.S., this macroprudential approach. So what is your take on that? Because if you look at this, macroprudential policy is not going to deal with any of the issues that you are pointing here.
Yes. Macroprudential policies are going to do nothing about this. In fact, if you look at the Basel III rules, there are hundreds of categories of the amount of capital that has to back particular kinds of loans. Talk about lobbying, right? This gives banks tremendous discretion in terms of how much capital they're going to hold. Why won't macroprudential policies matter, particularly in the United States? Here's a fundamental fact about the U.S. This is the Gini coefficient of, I don't know if you can see the names, basically of all the large OECD countries, the United States is in the middle. It's the one with the smallest red portion, okay? The combination of the red and the blue is the Gini coefficient, the income inequality coefficient, before taxes and transfers. It's what the market produces. And you'll notice that the United States is in the middle. It's not like the United States economy produces more inequality than the German economy, or the Swedish economy, or the UK economy, right? It's that the United States economy redistributes very little. So the part that is the genie after taxes and transfers is the blue. And so you see places like Sweden, which has the combined red and blue together, right? Very high inequality, but after taxes and transfers is a very low inequality country. Okay, now look at the United States. I'm going to have to stand up. Forgive me. Here's the United States. After taxes and transfers, it's very low. Excuse me, very high. Why? Well, it's not like the United States doesn't tax. It's that all these other countries, for good historical reasons, all became pacifists. The United States basically convinced them to become pacifists, stop killing each other, and we would provide for their collective defense. And so we spend a much larger percentage of GDP on defense than any other country in the world. That's historically meant that we redistribute very little through the fiscal system, though we tax a lot. Believe me, tax rates are really high in the U.S. What does that mean? It means that if you think about how inequality was handled under both the Clinton administration and the Bush administration, it was done through housing policy. It means that there are strong incentives to do it again. Because you don't have to vote for more taxes. You don't have to vote for redistribution. You just have to change the rules under which Fannie Mae and Freddie Mac buy mortgages from banks. And they've already started to do it. And this will become a big political issue going forward because the inequality issue in the United States is not going away. So the macroprudential policies, I don't believe, are going to matter at all. In fact, as you pointed out, there's nothing in Dodd-Frank that prevents any of this.
There are no further questions. I would like to thank
Sure.
our speaker today. We still have more time to continue talking, but just to say goodbye to people that are connected over the internet. And thank you very much to all for coming to this joint seminar between the Bank of International Settlements, Bank of Mexico, and SEMLA. So, thank you.